Let's say all of a sudden you have $2 million, but before you even think of spending it, IRS will knock your door. They will investigate you and your source of income. If it's legal, then you have to pay a heavy chunk of money in tax, and then you can spend it. But if the money is illegal, you will be in prison. But how do these powerful crime empires sustain their business? How crime lords own casinos or nightclubs? Right? Well, here's the answer. Behind every powerful crime empire, there's one skill more important than pulling off the heist or smuggling the goods: not getting caught. And the only way to avoid that spotlight, you need to master the art of making dirty money look clean. This isn't just some backroom trick. It's a global game of smoke and mirrors called money laundering. It's how cartels buy nightclubs, corrupt politicians fund real estate empires, and cybercriminals turn stolen crypto into luxury lifestyles. They use banks, shell companies, casinos, fake invoices, anything to confuse the trail and make the money blend in with the rest of the economy. So what is money laundering? Money laundering is the illegal process of taking money earned from criminal activities such as drug trafficking, embezzlement, arms smuggling, cybercrime, or corruption, and making it appear as if it came from a legitimate source. It's the financial equivalent of cleaning something dirty, hence the term laundering. The goal is simple: disguise the illegal origin of the money so that criminals can freely use it without raising suspicion from banks, governments, or law enforcement. If dirty money enters the economy unchecked, it can be used to buy homes, fund businesses, bribe officials, or even influence elections, all while staying under the radar. The first step in money laundering is placement, where illicit money, usually in the form of cash, is introduced into the legitimate financial system. This is often the most dangerous stage for criminals because it involves handling large volumes of dirty money in a way that could easily draw suspicion. To reduce the risk, criminals may break the money into small deposits across different bank accounts, a tactic known as structuring or smurfing. For example, a drug dealer might avoid detection by depositing just under the bank's reporting threshold across multiple branches, or using friends and associates to do the same. Other placement methods include using cash-heavy businesses like restaurants or nightclubs, where illicit funds are mixed with daily revenue, making them harder to trace. Once the money is in the system, the next challenge is to hide its criminal origins. After the money has entered the financial system, the next stage is layering, a process designed to obscure the trail and confuse investigators. This involves a complex web of financial transactions intended to break the connection between the money and its criminal origin. Criminals might transfer funds between multiple accounts in different countries, buy and sell high-value items, convert money into cryptocurrencies, or use fake invoices to simulate legitimate business transactions. A striking real-life example of layering is the Danske Bank scandal, where over $200 billion in suspicious transactions passed through a small Estonian branch. Shell companies with anonymous ownership were used to move money through multiple jurisdictions, making it nearly impossible to track its true source. By the time the money passes through enough layers, it becomes extremely difficult for law enforcement to trace. The final stage is integration, where the laundered money is reintroduced into the economy in a way that makes it appear completely legitimate. At this point, the money can be used freely, invested, spent, or saved without raising suspicion. Criminals often buy real estate, luxury vehicles, artwork, or even start businesses as a way to spend the cleaned money. For instance, a corrupt politician might use funds routed through offshore accounts to purchase upscale properties in cities like London or New York. Because the money has passed through several layers and arrived via seemingly legal channels, it now blends into the economy like any other legitimate income. Integration completes the laundering cycle, and, if done successfully, it allows criminals to enjoy the profits of their crimes in plain sight. Okay? Now, you have understood what money laundering is and the 3 stages of money laundering. Here's how you can clean your money. 1. Real estate laundering. Real estate is one of the most popular and effective tools for money laundering. It offers high-value assets, long-term investment potential, and relatively low regulatory oversight in many parts of the world. Criminals use real estate transactions to convert dirty money into tangible property, which can later be sold or rented to generate clean income. A common method is to purchase property using shell companies, business entities that exist on paper but have no real operations, making it difficult to trace who actually owns the property or where the money came from. Once purchased, the value of the property can be manipulated. It can be intentionally underpriced to hide excess funds, or overpriced to justify large cash movements. One real-world example involves Mexican drug cartels, who have used these techniques to purchase commercial properties across the United States. By hiding behind layers of ownership and inflating property values, they effectively clean their illicit proceeds and establish legitimate-looking investment portfolios. In many cases, these properties continue to generate legal rental income, further embedding criminal money into the legal economy. Second, trade-based laundering. Trade-based money laundering, TBML, is one of the most complex and difficult to detect laundering techniques. It involves manipulating international trade transactions to shift illicit funds across borders under the disguise of legitimate commerce. Criminals exploit global trade systems by over-invoicing, under-invoicing, multiple invoicing, or even falsifying the quantity or quality of goods. One of the simplest examples is a company that claims to export everyday items, like pens, but reports their value at $10,000 each. In reality, the pens are worth only a fraction of that, but the inflated invoice allows the exporter to receive a large payment from a foreign buyer, which is actually just another front controlled by the same criminals. This technique allows them to shift vast sums of money internationally while appearing to operate a legal business. Since customs and trade systems vary by country and involve vast volumes of goods daily, detecting such manipulation is extremely difficult, especially when supported by fake documentation and complicit trade partners. TBML has become a favorite method for laundering money linked to drug trafficking, terrorist financing, and organized crime, especially in regions with weak customs oversight. Third, casino laundering. Casinos have long been attractive to money launderers because they naturally deal in large volumes of cash and chips and can offer a legitimate-looking cover for suspicious transactions. In a common scheme, a criminal walks into a casino with a large amount of dirty cash, buys chips, and either plays minimally or not at all. After a short time, they return the chips and request a payout, often in the form of a check or bank transfer. The funds now appear as gambling winnings, making them look legitimate. Some even go a step further, using accomplices to create the appearance of actual gambling activity. In places like Macau, Las Vegas, or Canadian casinos, authorities have uncovered laundering operations involving both organized crime and international actors. The combination of anonymity, international guests, and high cash flow makes casinos a tempting hub for blending illicit funds into the legal financial system. 4. Cryptocurrency laundering. With the rise of digital finance, cryptocurrency has become a powerful new tool for money laundering, one that offers both anonymity and speed. Cryptocurrencies like Bitcoin and Ethereum are recorded on public ledgers, but laundering becomes effective when criminals use privacy coins, like Monero or Zcash, mixing services, or tumblers that scramble transactions and obscure their origin. For example, stolen or illicit crypto can be passed through a mixer, which blends it with thousands of other transactions, making it nearly impossible to trace the original source. A high-profile case involved North Korean hackers who used mixers to launder hundreds of millions of dollars in stolen crypto after cyber attacks on exchanges. Additionally, criminals often use decentralized exchanges, DEX, NFTs, and play-to-earn platforms to disguise transfers. Because crypto markets are still lightly regulated in many countries, law enforcement often struggles to keep up with the speed and complexity of these transactions. 5. Luxury goods and art laundering. High-value goods like artwork, watches, jewelry, and collectibles are another discreet yet effective way to launder money. These items can be purchased with illicit funds and later resold or appraised at higher values, turning dirty money into clean capital gains. What makes luxury goods so attractive is that they can hold or even increase their value over time, and many sales can be done privately without the same scrutiny as traditional banking transactions. A criminal might, for instance, buy a rare painting for $2 million using a shell company, store it in a private vault, and resell it years later through an auction house, pocketing clean profits. The art world is especially vulnerable due to limited transparency, anonymous buyers, and fluctuating valuations. In some cases, paintings or watches are simply used as portable assets, easy to smuggle across borders, hide in storage, or trade discreetly among networks of criminal enterprises. 6. Shell companies and fake businesses. One of the most common and sophisticated laundering methods is through shell companies, businesses that exist on paper but have no real operations or employees. Criminals use these companies to disguise illicit cash as legitimate revenue. For example, a shell company might issue fake invoices to another company, also controlled by the launderer, allowing dirty money to flow through as if it were payment for goods or services. These businesses can exist in tax havens or countries with weak corporate transparency laws, making it nearly impossible to trace the real owners. In major scandals like the Panama Papers, countless shell companies were exposed as fronts for moving billions in illicit funds globally. 7. Offshore banking and tax havens. Offshore banking involves placing funds in financial institutions located in countries with strict bank secrecy laws and minimal regulatory oversight. These tax havens allow account holders to conceal identities, avoid taxes, and transfer money across borders with little scrutiny. Criminals may open multiple offshore accounts, often under fake names or corporate entities, to move money discreetly. Countries like the Cayman Islands, Switzerland, Luxembourg, and the British Virgin Islands have long been associated with this type of financial opacity. When combined with shell companies, offshore banking becomes a powerful laundering strategy. 8. Money mule networks. Sometimes criminals recruit or trick individuals, called money mules, to move money on their behalf. These mules might be paid or manipulated via job scams or phishing emails into receiving and transferring illicit funds through their personal bank accounts. Because these transactions are made by seemingly ordinary people, they are less likely to raise immediate red flags. This method is especially popular in online fraud, romance scams, and cybercrime, where money needs to be quickly distributed across multiple countries. 9. Charities and non-profits. While most charities do good work, some are used as laundering vehicles. Criminals set up fake or under-the-radar non-profits that receive donations or supposedly provide services, but actually serve to move illicit funds. These organizations often operate in cash-heavy environments or across borders, making it difficult to trace donations or service payments. Some cases have even revealed that funds were being laundered under the guise of humanitarian aid or disaster relief, masking the movement of money into conflict zones or terrorist groups. If you like this video, please give this video a thumbs up and subscribe to this channel for more content.